right, future CFO, let's do this. Get your monthly financial reports out and let's find some nuggets. This is where we are going to analyze and use financial reports to optimize cash flow, operations, and profitability. This module can be used as many times as you need it because the goal is to graduate you out of needing it. But in order to do that, we have to get into the flow. And it needs to become second nature to you. Just like in the book Traction, Gino Wickman gives us a few crucial pieces of number, one of which is 7. It takes 7 times of doing, saying, or hearing something in order for it to stick. So watching this each month and following me as I go through each concept will graduate you into reviewing monthly financial statements like a seasoned CFO. Because this can be really fun. Once we get the hang of it, we can get a lot of great information. This is where your power lies. If you can consistently bring yourself and your numbers to the table every month, I guarantee you this will get easier and quicker, and you will become the CFO of your law firm and life. Reviewing your financial statements allows you to be able to see the path to your growth goals clearly and in very tangible steps. You'll be able to communicate those goals to your team so they have solid numbers to be accountable for. You can maximize your personal benefit. You'll learn how to think about the future strategically, have an airtight cash flow system, because numbers are a mirror to everything in your firm. So here are the 3 financial reports that you should have in front of you. They should be delivered to you every month like clockwork and preferably by the 15th. Financial reports show you what has already happened and what you can't change, but what you can learn from. So we are going to be going over the income statement or the profit and loss, which tells you if you're making or losing money, your balance sheet, which shows you what you own versus what you owe, and your budget variance, which tells you how well you anticipated your money flow. At this point, you should also have your KPIs handy as you do your review. Key performance indicators are the needle movers in our firm, and we're not going to go over them in detail today, but if you have not already, we have a module on KPIs, what data you should be collecting, reporting, analyzing, and how to use them. Another suggestion is to have your bookkeeper or accountant send you your income statement and your balance sheet in a month-over-month and year-to-date format so that you can see previous months and year-to-date, which allows you to identify visual trends. So log into your accounting software, find the reports, and open them up so they're handy in case you want to drill down into the detail of anything you see as we go through each report together. Becoming familiar with how to navigate your own accounting software eliminates any dependence you may have on your bookkeeper to answer simple questions quickly, and it's one less thing to get hung up on. Remember, you can delegate the role of CFO, but you do not want to abdicate it. I suggest starring these custom report layouts in your accounting software so you can easily find them. If you're also a person that likes pen and paper, print those financial reports out and look at them in your accounting software so that you can make notes either digitally or pen and paper on a PDF version of each of these reports. And give your bookkeeper grace when you find something. This is something where it's probably not a matter of if, it's a matter of when. Bookkeepers deal with a ton of granular data, and it's not uncommon for you to find something somewhere. But don't get hung up on the small stuff. Focus on the big picture. I'm teaching you a framework of how to extract gold from your financial reports. Once you master this process, you'll breeze through the numbers and get what's most important and see what's behind them. So the 10-minute review looks at the most important numbers first. Then we're going to back into the 3-step process so that we can reflect on the operational story, which is where we extract those actionable ideas. The 3-step process consists of circling what raises questions, tying in key performance indicators, KPIs, and asking and answering why 3 times on what went well versus what did not go well. The first why is usually very surface. The second why is where we start to spin our gears and really think. And the third why is where we tend to hit gold, which more often than not comes down to a core value or belief around your money mindset. So step 1, circle what raises questions. This is likely going to result in a list of questions to take to your bookkeeper. It usually has to do with inaccurate coding, in which case communicate with them and keep it moving. 9 times out of 10, it's not a big deal. It could also have to do with missing revenue or expenses. So consider the timing of payments. Most of you are getting financial reports on a cash basis. So if a payment came in at the end of the month and didn't clear the bank until the next month, it might not be in the month that you're looking at. Sometimes it has to do with your general understanding of accounting principles, in which case circle it and talk to your bookkeeper so that you can gain understanding. And those darn AMAs, those ask my accountants, those transactions that bookkeepers and accountants aren't 100% confident about where to code, so they need to ask you. It's annoying, but be sure to keep those clean. Step 2 is tying in key performance indicators. KPIs, if managed correctly, will tell you what to expect in your numbers. As you consistently review them over time, you will develop intuition around what to expect. So again, in this module, we're not going to discuss KPIs in detail. There's a separate module you can watch if you have any confusion on KPIs, what to track, when to look, and how to use them. The most important KPIs are found around revenue, accounts receivable, marketing, and your team. Which brings us to step 3. Ask and answer why 3 times on what went well and what did not go well. Because the first why is usually a hunch. The second why gets the wheels spinning. And the third why is when we tend to hit gold, which often can be a core value or belief in your money mindset. More often than not, when you go through this process, you're going to come up with some things that you're going to consult on with your team. Not only your key financial players, but your internal team as well, so that you can apply what you learn as a standard operating procedure. A lot of times when we find things in the financials, it's because of a lack of systems and procedures internally. And this is our opportunity to integrate that into our operations. So let's get to it, starting with your balance sheet. The balance sheet is going to be really quick because most of the gold is on your income statement. Using the 10-minute review process, we're first going to look at the most important numbers. Now, your balance sheet is assets equals liability plus owner's equity. Essentially, it's what you own and what is owed to you, what you owe, and the lifetime profitability. So now let's walk through the 3-step process. Circle what raises questions. This might be negative balances, missing accounts, or accounts that should not be there, or maybe the number just feels incorrect. These are the items you're going to want to take to your bookkeeper. Then you can tie in your key performance indicators. Some KPIs on your balance sheet are going to be cash reserve. Did you have 3 to 6 months of padding in your accounts if that's a goal of yours? Do you own more than you owe? Do you have enough cash and assets to cover debt? Looking at your debt, is it decreasing or increasing? And looking at your accounts receivable, which probably doesn't show up on your balance sheet. If you carry an accounts receivable, if clients pay invoices over time, it's likely in a practice management software, and you can pull that report and look at it while you are looking at your balance sheet. And then we want to ask and answer why 3 times about what went well and what did not go well. so we can reflect on the operational story behind the numbers. So looking at cash, for example, if it's running low, we need to ask and answer why 3 times. And some common reasons could be unpaid invoices, in which case we need to look at accounts receivable follow-through procedures. Are they non-existent or not being followed? If you allow your clients to pay invoices over time, use the rule of 7 that Traction tells us about in this process. So when you first meet with the client, make sure you have transparency from the very beginning. Have milestones of past due consequences, a 30, 60, 90, 180-day aging procedure. And you can automate this system using technology and create touch points before it ever gets to a past due milestone. Sometimes cash can be low because we're simply spending more than we have. So look at what you spent money on and ask yourself, could you have waited or done without? What are some expenses that you know you can cut? So evaluate what you need versus what you want. Optimize your team efficiency and production, and optimize your strategy to get new clients. Or maybe cash is looking high. It looks great. You're really happy with what you see. We still want to ask and answer why 3 times. So looking at your revenue, was it high? Did you have unusually high new clients? And what is that attributed to in marketing and sales? Or maybe you took out a loan and put them in the cash account, so it wasn't a result of increased revenue. Maybe you took out a loan, so ask yourself why. Was payroll short? In which case, look at team efficiency. But there are always 3 layers deep that we need to go to get the gold. Now take a look at debt. If you have new debt, ask yourself, why did you need it? Did you have a strategy to pay it back? Can you pay it back quicker or early? And are you positioning yourself in the future to not rely on debt? Are we correcting the reasons that led us to take on debt? If debt is consistently increasing, that probably means that you are consistently spending more than you have. So look at things like, are you billing all of your work and charging enough? Go back to evaluating what you need versus what you want, optimizing your team and your strategy to get new clients, and create a plan to pay it back and get out. On the other hand, if debt is consistently decreasing, this is a good thing, but we still want to think 3 steps ahead. What will you do with that cash when it's paid off and it's freed up? How can you invest it into growth? Now, equity is a section that you won't look at a whole lot, but I still want to give you some FYIs. Items you might see in the equity section are current year earnings, which is your net profit or loss and should match your year-to-date income statement for the same date. You'll see your owner draws or distributions, and this number represents how much you've taken over the life of your business or your books, if you didn't keep books for the life of your business. So it's important to know that this number is cumulative. It is not for only 1 month. You can click that number and adjust the dates to see a specific time frame if, for example, you want to see how much you took in draws or distributions for the month, the quarter, the year. And you'll also see retained earnings. Retained earnings represents the net profit or loss over the life of your business or for however long you've been keeping books. And it doesn't include the current year. So at the end of the year, current year earnings closes out into retained earnings, reflecting the lifetime profitability of your law firm. That brings us to the income statement. So the first step is looking at the most important numbers. Your income statement represents your taxable revenue minus your tax-deductible expenses, which answers the most common question, where a blind spot is, where is my money going? And equaling your profit or loss. In other words, what you are taxed on. And it's important to know that your net profit or loss is not representative of your cash in bank. That is your cash flow, not your net profit or loss. So let's back into the 3-step process for your income statement. Step 1, circle what raises questions. This might be things like negative balances, missing accounts or accounts out of place, or maybe the number just feels incorrect. Those are the items that you will take to your bookkeeper. The key performance indicators that can be found on your income statement revolve around revenue or sales, marketing, and team. And we will do the 3 layers deep, asking and answering why, so that we can reflect on the operational story behind the numbers. So first, draw your attention to your net income or loss. Are you actually making money? If it's a loss, think about, could it be seasonality? Is it a temporary loss? A lot of practice areas experience seasonality, especially those in family law. Come to find out, people don't want to get divorces around the holidays, so they wait. And Q1 is usually the highest revenue months for things like divorce. Is it because of abnormally high expenses? Maybe you moved office space and spent extra money that you won't be spending like that in the future. Maybe you invested in a high-ticket coaching program or marketing strategy. It was an abnormal one-time expense that could create a loss, but it won't be consistent. If not, consider if it is a pattern that needs correcting. Are you spending more money than you are bringing in? If you see a profit, ask yourself, is it more than you expected? And we still want to go 3 layers deep so that we can leverage what we find and what is working. Then scan up to the top and look for total revenue. You should be able to answer questions like, which services brought in the most or least revenue? And does that surprise you? Now, if your chart of accounts does not separate your revenue based on practice area and matter types, I highly recommend that you work with your bookkeeper to set it up this way. Some of you might be able to get this report from a practice management software that you can look at while you are looking at this section. Looking at especially your income statement in a month-over-month and year-to-date format, can you identify patterns in seasonality or based on your marketing efforts or team changes? And is revenue growing over time, but profit is not? A lot of times there is a misconception that we have to spend money to make money, and in most cases, it's not necessary. There's a law out there called Parkinson's Law, and it says that for every increase in revenue, expenses will meet or exceed that increase in 3 to 6 months, unless you have a specific force working against it. So as we grow and bring in more revenue, we want to be very conscious to protect profits. And we do that by using things like budgets and forecasts, honoring those boundaries that we have put into place with our money. Some key performance indicators when you are looking at revenue are going to be things like lead source, lead quality, non-conversion reasons. Why aren't people signing up? Conversion rates, days to close, days to onboard, recurring clients, average case value, profitability per matter type, and collection rate. So again, if you want to learn more about exactly what these are, how to collect, report, and use them, watch the law firm KPI module in this course. But the idea of approaching your revenue section is that we looked past the numbers and into these KPIs. If you stay on top of these KPIs each week, revenue should reflect what you expected. You will have already been prepared for what you're looking at. Now draw your attention to your marketing expenses. Consider which costs should have an ROI, a return on investment. These are primarily going to be paid ad spending that you are looking to directly obtain new clients with. On the other hand, which costs are more functional or brand awareness? When we spend money on these types of things, we're not typically expecting new clients, but more so staying front of mind for when they do need our services. And ultimately ask yourself, are they working? When you're done looking at your marketing expenses, look at your team costs and ask yourself, am I measuring the performance of all positions? Every position has a number, and we cannot measure what we cannot see. Even with your non-billable team, you can create a measurable system with KPIs that indicates, are they doing well? Are they productive? Consider if your team is working collaboratively and according to the highest and best use of each of their positions' time. And also think ahead. What are your next 3 hires going to be? Looking at your KPIs for marketing expenses, some of these KPIs are going to tie into your revenue KPIs, but specifically, we want to consider the lead source KPI. Be adamant about understanding how people are hearing about you and if it is a result of a line item that you see here. So keep in mind that if you have multiple marketing efforts, you want to consider siloing those efforts. Instead of looking at all of your marketing metrics as one, if you are on multiple platforms, it can be helpful to evaluate those platforms and your strategy independent from one another, because LinkedIn does not work the same as Facebook and they do not draw the same eyes. Consider things like engagement tracking on your different platforms and your website, of course, conversion tracking, and consider your return on investment for the line items where you are paying to obtain new clients. When looking at your team expenses, we have to consider 3 different metrics: financial metrics, profitability metrics, and operational metrics. The financial metrics are going to be your total team cost as a percentage of revenue. Now, your bookkeeper can probably send you a report that shows you percent of revenue, but if you have organized your chart of accounts in the way that we have suggested, you will see a total team expense line item. Just take that number, divide it by total revenue, multiply it by 100, and that is the percentage of revenue that you are reinvesting in your team. Then look at, is your revenue 4 to 5 times more than your billable positions? An industry cookie cutter standard for the legal space is that your billable team members are 4 to 5 times ROI, meaning they should be bringing in 4 to 5 times in revenue what it is costing you to compensate them. Now, this is just a cookie cutter industry standard. I have seen business models where it is less and for good reason. And on the other hand, I have seen business models where it is a lot more because they do things like outsource overseas and maximize efficiency and technology. Another set of KPIs that you should be looking at weekly have to do with profitability on the billable staff. Things like utilization rate. Are they spending the highest and best use of their time on billable legal work? Realization rate, which is the percentage of billable hours that are invoiced and collected. We want to make sure that legal work is being billed and time is being tracked, and we are not missing opportunities. And also the collection rate. How are you collecting on the invoices that you send to your clients? The operational metrics to consider is that you are delegating efficiently. So going back to the idea that billable positions are spending at least 80% of their time on work that will end up on an invoice. Consider your current team's available capacity. So thinking 3 steps ahead, how much can you grow? How much time does each person in each department have as you grow before you need to consider hiring someone else? Case turnover time, which is the average duration from case opening to closure. This helps us anticipate our team's workload, especially when we get out of the rearview mirror and start planning for how many new cases we're bringing on to grow. And client satisfaction score. This one is often missed, especially in law firms, and it's something that comes up year after year in the annual Clio report. Client satisfaction and paying attention to how you can create an experience when your clients are doing business with you and your team. Measure the experience and the referral potential so that you can make sure you are giving them a good experience and communicating proactively. Now we get into the budget variance. A budget is a tactical solution to a psychological problem. The word budget tends to bring about cringe feeling in most people. It feels restricting and ick. It's another thing that begs a shift in perspective, especially for business owners. So view it as a tool that defines spending boundaries so you can protect profits and ultimately cash in your pocket. If you haven't completed your 12-month money blueprint forecast by the time you watch this, prioritize working with us to get it done so you can start getting this report every month. What a budget variance will show you is what you anticipated versus what happened in reality, gifting you the opportunity to explore the difference and learn to get better. It shows you how accurate were you in predicting revenue. Are you prepared for upcoming expenses? Are you measuring marketing investments to ensure an ROI? Are you planning for new hires? And how well did you anticipate cash flow? It's generated using the numbers we came up with in your 12-month money blueprint forecast. Any adjustments made to that Excel forecast must be reflected in your accounting software using the budget manager. While in this program, me and my team manage this for you, updating the Excel forecast as needed and during your quarterly pivot, and going to your accounting software to update it in the budget manager. So your balance sheet and your income statement show you what has already happened and what you cannot change, but you can learn from. This tool is where we get out of the rearview mirror and look into the future of revenue milestones, operating expenses, team support needs, and cash flow. And we still use the 3-step process, starting with circle things that raise questions. These are typically going to be things like the number feels incorrect, missing accounts or accounts out of place, or substantial variances that may need adjusting. Now, especially when you look at this report, keep in mind that we have probably changed a lot for your bookkeeping team. We've installed a new chart of accounts, giving them a new way of coding expenses. Miscodings happen, and your bookkeeper will care more if they see that you care more. And when you look for substantial variances, remember the idea that we want to focus on $30,000 items, not $3 items. So the things that are small, we are not going to worry about. It's the big things that really catch us off guard. Small things, we are going to adjust during our quarterly pivots. Big things are what we're going to want to adjust monthly. And usually that's things like removing, adding, or replacing team members, high dollar marketing investments, other high dollar programs, maybe travel that you are planning and that is not accounted for, and revenue adjustments based on consistent variances. Because if you get this report with the year-to-date column, naturally, you're probably going to have swings month to month. But if you are still on track year-to-date, we probably don't need to make an adjustment until your quarterly pivot. Quarterly pivots are for the $3 changes, not the $30,000 changes. Those we want to keep up with monthly. While you're in this program, adjustments can be reported to us, and we will update your 12-month money blueprint forecast as well as the budget manager in your accounting software. The key performance indicators on this report are the variances that stick out to you. So what step 3 looks like when you're looking at your budget variances, starting with revenue, did you hit your goal? And ask and answer why 3 times. This is where looking to your KPIs for guidance is really helpful. We want to correct what fell short and leverage what worked better than expected. And scanning over your expenses and looking at team expenses. Are they what you anticipated? Team expenses shouldn't have that much of a variance. They should be pretty predictable. And look to your KPIs for guidance if you see a big variance. Ask yourself, are there opportunities to increase efficiency through technology or redelegation of duties, highest and best use of time? Did your team hit their measurable KPIs that month? And something we see often, and especially in heartfelt business owners, we have to always consider, are we molding seats around a person? Your business is a bus, and the seats on that bus should be defined by the position so that we can find the right person for that seat. We don't want to be in a position where we are finding or keeping people that we just like, but we're molding a seat around them, because the truth is we never know when people are going to leave us, and we need to have a well-defined seat to find the right person. When it comes to your marketing expenses, do you have a set budget and did you honor it? Are your metrics strong? And are there any ROI opportunities? And with all of your other expenses, are there things that need to be added, removed, or adjusted in your future forecast? Then we go to the very bottom, your net profit and cash flow. Did you meet your anticipated net profit? Did you fall short, or did you do better than expected? If you hit your net profit goal, you've likely hit your cash flow goal. We plan for this in your money blueprint forecast in the balance sheet items affecting cash section. These items are going to be things like your owner draw or distribution and principal payments to loans. They represent cash coming out of the bank, but not something you will see accounted for on your income statement. That is the difference between net profit and cash flow. Also consider that after your cash flow numbers, there are two things that need to be considered with your cash flow line item, and both of which we have also planned for in your money blueprint. Cash flow is before estimated taxes are paid and any profits that you plan to save or hold on to as a traditional savings fund come out of this number. This is another reason why we recommend the cash management account system consisting of multiple bank accounts so that you can intentionally set aside cash for tax purposes and so you can keep your profits. So ultimately, if you have hit your net profit goal for that month, you have hit your cash flow goal. At this point, we've covered all three financial reports. The ultimate goal of reviewing financial statements is to take meaningful action on what you find, both good and bad. Meaningful action that will keep you in a state of preparedness and always looking for improvements. So you should have now a list of questions to iron out with your bookkeeper that holds you responsible for learning and them accountable for how you want your data presented. You should have a list of new processes to implement for key performance indicators, new goals that need to be communicated with the appropriate team members, and a list of ideas to consider, some of which beg for your team's input and collaboration. We have a team mantra here at Core Solutions Group, and it goes, every 1% matters. By approaching your financials with curiosity, you are looking for ways to improve, and there are always ways we can do better. The best way to take action is to rely on your team. Having a team means you have to master the art of leadership. I have seen leadership make and break profitability. It's something that numbers show in the form of low team productivity and high turnover. This is where the book Traction can help us again. It presents a systematic approach to effectively managing your team and positions so that you can hone in on your leadership skills. Traction inspired me to develop what we here at CSG refer to as pods. Each pod is a department and has a focus. Each member is in some way involved with the focus topic of the pod. Each pod has a different meeting frequency, and how often we meet can change depending on what's going on and as we learn and get better. They say you can tell a great leader because they have a team of leaders. We truly have a phenomenal team, and they have earned my full confidence, and they know it, they feel it, and it makes them that much more motivated and dedicated. My team is so amazing that I've learned that when a potential mistake or mishap is brought to us by our clients, I have to first ask my team questions because the fact is 9.7 times out of 10, my team has not done anything wrong. It's more of a matter of communicating and educating the clients. And look, we are small businesses. Most of our team can make more money somewhere else. What we have to offer that corporate America doesn't is something more valuable than money. And that is what this can do for you. And your financials can be the starting place. Here's what we use to track meeting goals, projects, new ideas to integrate. It's a spinoff of a similar traction tool, and it's in this module as a downloadable if you'd like to use it in your law business. It outlines and keeps at the forefront our 1-year plan, which you can use your money blueprint forecast to create. Now, I believe in transparency, so my team knows our money goals. So in addition to keeping the 1-year plan in sight, we have what Traction refers to as rocks, objectives, deliverables, projects. Rocks are kept at the forefront each quarter, and we identify what they are and who is responsible for executing them. And another thing I love and believe in is the issues list. We all have weeds in our garden, and instead of letting them overrun our garden, we can bring them to the forefront and have transparency with what we are not doing well so that we can prioritize them, discuss them, and solve them. It works amazingly. Consistency is key. And this is where I really love that rule of 100. 100 hours a year of doing something and learning something makes you better than 95% of the world in that discipline. It'll take you longer in the beginning, but give yourself grace. Lean on the tools that you have right here and in our Slack community and those who are learning alongside you. Remember, 7 times. Most of you are doing all of this for the first time. It's your first time engaging at this level with your bookkeeper, the first time you're approaching your financials with a new perspective, collaborating with your key financial players, the first time you're communicating measurable goals and expectations to your team, and the first time that you are fully stepping into your leadership role. Give these individuals and yourself time and grace. Remind them and yourself of why this is happening and what the new expectations are. And ask questions before assuming anything.